So we can talk about the 3-month 10-year, but you actually have your own yield curve that you look at, backing out certain factors. What is it, and what has it told you?
Yeah, I mean, look, obviously this has been a different era, right? QE, QT, extraordinary monetary policy. And so what I hear out there, when we first inverted back in March, I heard the yield curve apologists, as I like to call them. They're out there talking about how, well, it's different this time because of the monetary policy. Their term premium is negative. German bonds are negative, so that's weighing on the back end. And I think that's just a bunch of baloney. I think that the yield curve is still is a very good signal. Okay, so first of all, we did invert in March, but then it stopped inverting. So that's a positive signal, meaning it needs to stay inverted. So what we did is we looked at a yield curve. If you adjusted for QE, and then you adjusted for QT, what it did was it actually steepened the curve a lot more in obviously the QE era, because if you look at the shadow Fed funds rate done by the Atlanta Fed, they argued that QE is worth about 300 basis points of additional cuts. So that would obviously steepen the curve dramatically more in the 2011 to 14 period, which it did, which was necessary to get the economy going. So it makes a lot of sense. But then QT was worth probably between 50 and 75 basis points of rate hikes, which means when you put it all together, we actually inverted last fall, well, really November, December, which is about the time the market kind of, crapped out. And it stayed inverted that entire period, meaning you actually have checked the box on this idea that we've been inverted now for 6 months, so it's a valid signal.
So let's talk a little bit about that, because there's a lot to unpack. I think a lot of people look at the inverted yield curve as if it's a binary event, but you bring up a really interesting point. When we get an inversion that's short and sharp, that's very different, or short and shallow, that's very different than a longer duration inversion that is deeper, and you're suggesting back out QE, and that's what we have, a longer inverted yield curve?
Exactly right. And QT is part of that too. On the other side, and look, I think it explains what's been going on in the volatility markets as well. We had a chart in our note this week, which is really empowering, because I like to have a thesis, but I like to test it in the marketplace. So there's a very good relationship between the yield curve historically as a leading indicator for the VIX by about 3 years.
So bond market leads to equity volatility.
Or any kind of volatility, which makes perfect sense, right? I mean, the Fed is tightening policy. Clearly, it's going to lead to higher volatility in financial markets, but with a big lag. And so what we noticed was a couple years ago, volatility actually kind of got away from the yield curve prediction. But if we overlay our new yield curve on that, it actually fits perfectly, which suggests the new yield curve is real.